fascinating because, go back to like, why do I want to buy, the proverbial toothpaste company with a 3 or 4% yield rather than a speculative endeavor? What as a one-man business operator, a restaurant owner that I might be, or something like that, what would I do for a living as a one-person business that everybody can identify? A restaurant owner. Let's go with it. Well, like, what's the best restaurant that I could own in terms of me, Jeff Weniger, sleeping at night? It's probably a stop in on the way to work, grab a cup of coffee business, because I know really, really confidently what my Monday through Friday sales are going to be. And I even know if there's 75% chance of rain, I can also probably predict my coffee sales, coffee and a donut. But what's really tough is if I have the $50 steakhouse and I don't know if there's going to be a 1 hour wait at Saturday night, or whether there's going to be, here, just take the great booth over there by the window. I don't know, because I have more business uncertainty. And maybe this goes back to what we were talking about earlier with why I want to domicile assets in country A versus country B. The greater my sense of uncertainty with respect to my Brazilian real or my Brazilian inflation, which is all over the place, compared to the safety and surety of, let's say, 1990s era US inflation, right? Operating a business in country A versus country B. This throws Mike Philbrick for a loop on his asset allocation, right? When I got German PPI at like 38 right now, and I'm supposed to form an opinion on the future of German industry. That's my job. Like, at Wisdom Tree, Jeff, have an opinion on German industries. Like, and guess what? The whole street is in the same boat as me. At least the four of us are honest about it. It's tough.
Well,
and so we have more business. Hold on, hear this out. So we have more business risk. So do I want to pay 20 times earnings for some broad market, or do I want to pay 18 or 16 for that broad market? Maybe that's why multiples are so low in the 1970s in the United States. And maybe that's why some of these countries always have single-digit multiples. Don't know if you can get a fair day in court, and so on. And so you start to wonder, okay, Mike Philbrick lays out a case where we don't know where inflation is going to be, but we know it's going to be doing this, rather than what it hopefully would do in a well-ordered society, which is this. And because of it, do we want those Russell 2000 growth companies? Is essentially what the situation presents itself, as opposed to the toothpaste and soda pop company.
Uncertainty premium essentially is what you're talking about.
Yeah,
and I just
a larger
expected soda return.
Pop, which is a regional thing up here in the upper Midwest. They call it pop. Down in Texas, they just call it Coke. Did you guys know that? That all soda in Texas, in certain pockets of it, they just call it Coke.
No.
In most of the U.S., they call it, what do they call it in Canada? Soda?
We call it pop. I thought it was more of a U.S. thing calling it soda, I thought. But
well, I'm from Brazil, Jeff, the country that you keep beating on. So I've only come to Canada. But anyway.
Some places call it soda pop. Some call it, I think 30 or 40 states probably call it soda. And then there's a few states up here in the upper Midwest where it's pop. And it hits you like a ton of bricks when you arrive in like an Illinois or a Wisconsin as a new arrival, like I did in my 20s. You want to pop? Like, oh yeah, that's right. They say pop. So I said soda pop. So how about that? So I don't know what state that might be. So I digress.
No, but look, I think that's the point. If you look at history, during periods of inflation volatility, because inflation is never just inflation all the time, right? Like, listen, look at Argentina, right? They'll be fine. They'll have 10,000% inflation. They'll do something, bring it back. They'll be fine. So inflation is volatile. And every time we've had periods in the 1940s, you also saw PE ratios go down, right? So the multiple gets contracted because you need the higher risk premia for investing in a company that has more uncertainty than ever, right? We've had a one-dimensional market for the last 40 years for the most part, which is more liquidity or less liquidity, high growth or low growth. If it's low growth, mad liquidity. If it's high growth, moderate liquidity. The Fed never really has had to deal with inflation as this kind of second layer that you need to account for, right? Now the Fed is limited by what it can do to fight inflation. So it's not like, oh, that's why inflation's up. The Fed's going to deal with it. We'll be perfectly fine. It's going to be a soft landing. We'll be great. So the more inflation volatility there is, the more business volatility there is, the lower the multiple historically that has been needed to get a bid in the market. Right now, I was just looking at the Schiller PE, right? So we peaked at, let's go back to the 2000. In 2000, we were 44 Schiller PE, right? We got to 38. I didn't even know that. We got to 38 last year, right? And we're at 28 now, okay? The historical average, the median is 15. It's never stopped at 15. It always deeper, right?
Yeah, and in 1920, I haven't tweeted the Schiller PE in a while, and
sorry that you guys.
Siegel has
yeah, we heard
some very cogent remarks with respect to like record keeping in the old days, and just there's better regulations, and that maybe the market would require a higher multiple. And so he makes a lot of good points on that. One of the cool things about when you're talking about, I think you said, did you say 44 was the March 2000, 38 in probably November of 21.
November of 2021.
And then that would be the Schiller PE, so that everybody knows that's the 10-year rolling average of earnings, and price divided by that. And then that way we can get it across the business cycle. That's for everybody to. And last time I looked at that chart, the thing about it was in 1920, very critical year, because we as a market decided that roaring 20s thing about a year ago. That Schiller PE was like 4, because it was still finishing off a war, and also the Spanish flu at the time, which Spanish flu peak stopped in 1921, was in the end of that pandemic. And so we were, oh yeah, it's going to be the roaring 20s was what everybody was saying when we come out of COVID. I was like, well, you guys, the starting PE multiple was like a 4 or a 5.
Yeah, April 2020 was 5.6.
Yeah, okay, 5.6. And so there is that big difference. And look, we need to unwind this market. The great news is that for last year we have been. There's a lot of the real speculative goof is still down 70, 80, 90%. But I worry. I worry about certain periods of time in the stock market lore, right? From 1968 to 1982, the S&P 500 had a bunch of bulls and a bunch of bears, and ended up in 1982 right where it was in 1968. And you got a dividend along the way. We always want to point that out. And what I keep pointing out to people is, maybe it's because the U.S. is more dynamic than the EFA components, EAFE, right? Europe, Australasia, Far East, MSCI EFA being the big index that we as an industry talk about for developed equities. Well, we're like 100 points north of the March 2000 high in MSCI EFA, which is the second most used index I use on a daily basis, right? Like in my business, we talk S&P 500 or Russell 1000, then we talk EFA, then we talk MSCI EM. There's like the 3 that an equity strategist talk about. There's a second one, and it applies to everything under the sun that's not emerging and not United States, right? Italy, Germany, France, UK, Singapore, and so on. And that thing is right back on a price index basis where it was 22 years ago. And yet, you talk to Americans, and they can't conceptualize a situation where the S&P 500 was 4,800 in the end of 2021, and maybe the end of 2026 or 2031. I don't know, but maybe it'll be 4,800, just like it was in the year 2021. And what do you do from a portfolio perspective? I don't know that I know, but I think it's clipping a dividend coupon. I don't know.